Analysis: Japan PM's political doom loop worsens her fight with markets. July 31, 2026. Japanese Prime Minister Sanai Takaichi is facing a sharp decline in public support, making it increasingly difficult to scale back promised tax cuts or reassure financial markets. Her approval rating fell to its lowest level since taking office last year as inflation, driven partly by the weak yen and rising import costs, weighed on households. Takaichi's commitment to fiscal stimulus, tax reductions, and criticism of higher interest rates has heightened investor concerns over Japan's already fragile public finances. Those worries have pushed Japanese government bond (JGB) yields to their highest levels in decades and weakened confidence in the yen. Government officials acknowledge that markets are exerting unprecedented influence over Japan's fiscal policy, raising fears of bond vigilantes dictating borrowing costs. Since becoming prime minister, Takaichi has tried to balance economic growth with fiscal discipline and respect for the Bank of Japan's independence. However, mixed messaging has often unsettled markets. Her latest spending plans, intended to ease households' cost of living burden, fueled expectations of higher government borrowing and sent bond yields soaring. Although Takaichi recently pledged greater transparency and closer communication with investors to rebuild trust, she also reaffirmed her determination to end what she calls Japan's excessive fiscal tightening through large-scale investment. Officials say her falling approval ratings only strengthen her resolve to pursue expansionary policies, leaving her trapped in a political dilemma. Abandoning stimulus could further erode public support, while continuing it risks unsettling financial markets. The challenge may intensify in coming months. The government is expected to proceed with a temporary 2-year cut in the 8% food tax despite concerns over how it will be financed. It also plans to remove spending caps for key growth sectors in next year's budget, potentially increasing both expenditures and government debt issuance. Analysts warn that without a credible funding plan, bond investors are unlikely to regain confidence. Economists argue that while recent declines in oil prices have temporarily stabilized JGB yields, markets continue to demand a higher risk premium because Japan's long-term fiscal outlook remains uncertain. The weak yen has created another headache. Despite repeated warnings from Finance Minister Satsuki Katayama about possible intervention, the currency remains near a 4-decade low. Japan's top currency official has stayed silent since the record $72 billion intervention earlier this year failed to reverse the yen's decline. Instead of verbal intervention, the government has shifted its focus toward providing clearer guidance on debt issuance and fiscal policy. Katayama recently emphasized that while the government will not impose a ceiling on annual debt issuance, it intends to keep borrowing within levels investors consider reasonable. Market participants welcomed the more logical communication, noting that policy announcements have repeatedly shocked bond markets and further weakened the yen. The government argues that expansionary fiscal policy will strengthen Japan's long-term growth potential, ultimately making both the yen and JGBs more attractive. Investors, however, remain unconvinced, expecting further rises in bond yields as government borrowing increases. Markets are also closely watching this week's Federal Reserve and Bank of Japan policy meetings. Although both central banks are expected to keep interest rates unchanged, any hawkish signals from the Fed could widen the US-Japan interest rate gap further, putting additional downward pressure on the yen. Former BOJ board member Takahide Kiuchi believes the administration has failed to solve its two biggest problems, collapsing public support and declining market confidence in Japan's fiscal policy. He argues that only concrete, credible plans for restoring fiscal discipline can rebuild investor trust. By Reuters, story by Laika Kahara and Tamiyuki Kahara.